Okay, as I just said, our first exam is next Monday. And when you think about the topics that are covered on the exam, we've got financial statements, transaction analysis, and the adjusting and closing process. And honestly, of those three topics, I think it's this one, the adjusting entries, that are probably going to be the toughest set of questions. So let's see if we can make sure we start getting this stuff down. Can we take a look at this problem that we're going to work together? Let's just read it so we know what it says. It says that the following accounts were taken from ABC Company's unadjusted trial balance at December 31st, 2027. And you can see the list of accounts. They are listed alphabetically, making it easy to find things. And the balances that I've given you are all unadjusted, meaning we've not yet recorded the adjusting entry for these accounts. It then tells me that ABC Company, as we just said, has not yet recorded adjusting entries for these 6 items here. And that is the first requirement of the problem, to write the necessary adjusting journal entries at December 31st, 2027. So what we want to be able to do is come up with our adjusting entries. Let's adjust the accounts. As of December 31st, 2027. And to kind of get us off and moving in the right direction, I'm going to do the first one. But I don't want to be the only one to talk. So once I kind of get through the first one, I'd like to hear from some of you guys to do some of the work on the other transactions here. But let me get us started. Number 1 says that salaries earned by employees which have not yet been paid by ABC Company amounted to $12,000. So what has happened here is the employees have worked. They have done their job. Payroll just hasn't processed yet. So as of December 31, we have not actually paid the employees for the work that they've done. But the key thing about these adjusting entries is we have to get a revenue or an expense recorded into the proper year. And the proper year of when we record an expense is when that expense is incurred. And it's incurred when the employees actually do the work. So we need to record salary expense in 2027, even though we have not yet paid the employees this money. So in my adjusting entry, the first thing I'm going to do is debit my salaries expense. This will record the expense in 2027, the year that the employees actually worked. Debit salary expense for $12,000. How about I don't do the entire first adjusting entry? This one I think is kind of easy. Anybody can answer. Just open the microphone on and tell me, what account should we credit in this adjusting entry?
Accounts payable.
Good job, Nick. I agree completely. And Nick, I'm going to make just one minor change, but the logic was excellent. As of December 31st, we owe our employees $12,000. They have worked, and we have not paid them. Nick, the one minor adjustment I'm going to make is an account payable is when we actually buy something and agree to pay for it later. Here, I think it is more appropriate to use salaries payable. Salaries payable represents money that we owe to our workers. So we'll credit our liability to record the liability, $12,000. And that's an adjusting entry. First one I think was kind of straightforward. But are there any questions on what we did here? All right, let's take a look at some of these that are a little bit more involved. Take a look at number 2. Number 2 says that the unearned revenue in the unadjusted trial balance, and remember, these accounts are listed alphabetically. So the next to the last one here is our unearned revenue. It says that the unearned revenue relates to a $27,000 payment that we received from a customer on June 1st of 2027 for services to be performed each month for the next 18 months. Can I have a volunteer to do a little bit of work, please? And my first question is going to be this. Unearned revenue is a brand new account. We just learned it this week. What type of account is it? Zane, your mic's on. What type of account is unearned revenue?
It is a liability.
Job. Zane, stay with me. I have a few more questions. But you are absolutely correct. Don't let the name of the account trip you up. Even though it says revenue in its name, it is not a revenue account. Unearned revenue is classified as a liability account. Zane, can you turn the mic back on? Next question, please.
Yeah.
Are you able to tell me, Zane, what exactly is unearned revenue? Why would a company record unearned revenue?
It's money we have yet to have received, correct?
Zane, I don't think I want to agree with that. I think I want to disagree with that. I
Okay.
don't think that's quite correct. We try, but you can go ahead and mute your microphone. Could somebody jump in and help out? Winta, what exactly is unearned revenue?
So I think unearned revenue is like the customer, they paid for a service ahead of time and you have to give them their service eventually.
I think that's an excellent answer. Good job, Winta. So Zane, the reason I wanted to disagree with you, if I heard you right, what you told me was it represented cash we had not yet received. And that's actually exactly opposite. Unearned revenue, like Winta said, we have gotten the money. The customer has paid us. And they have paid us, and we said, thank you, we'll take that cash, and we will provide services to you later. So we have not yet actually performed any work for the customer, but the customer has paid us. I'd like to write that. I think that's important to know. Unearned revenue represents cash that we have received for services to be provided later. This is why it is a liability. As soon as you take somebody's money, you are now liable or obligated to provide the service to them. They paid for it, you've taken their money, you owe them these services. So think of unearned revenue as being services that are owed. Winta, would you mind answering another question, please? If you want to turn the mic back on. Winta, are you able to tell me why is it in our problem that ABC Company will need an adjusting entry at the end of the year related to the unearned revenue?
Because it's for the next 18 months. So you'll need to do it like for 2028 as well.
Yeah, I don't disagree. A little, but that didn't quite answer my question. Winter, go ahead, you can mute your microphone. Can somebody jump in here and maybe help out? Nick, tell me, why is it that ABC Company will need an adjusting entry at December 31st, 2027 related to the unearned revenue?
Just looking at the date here, it looks like they've performed about 7 months of that work that they promised to pay. So you would have to adjust down the unearned revenue to account for the work that they have completed.
That's Nick's great job. 100% agreed. I'm going to ask you, Nick, for some numbers in just a second, but let me repeat what he just said. He said the reason we need an adjusting entry is by the end of the year, by December 31st, 2027, we have done some of the work. We have provided some of these services to this customer. And we need an adjusting entry to reflect that. The fact that some of the services have been performed and thus are no longer owed to that customer. All right, Nick, good job. Next question for you, please. If you want to go ahead and turn your microphone back on. Nick, are you able to give me the numbers out of the problem to figure out how much of the services we in fact performed in 2027?
Yeah, so I did 27,000 divided by 18, and I got about it's $1,500 a month worth of work. And from the beginning of June to the end of December, that would be 7 months worth of work.
Excellent job. Nick, in another minute, I'm going to ask you for the adjusting entry, but let me get everybody caught up. He says, well, look, here's what we know. We know that unearned revenue, the money that we received, was $27,000. And that was payment for services to be performed each month for the next 18 months. So we take that 27,000 divided by the 18 months of services we're going to provide. That tells us we are earning $1,500 per month. And to figure out how many months in 2027 we actually performed, do not eyeball things. A very common mistake is folks eyeball June 1st. And they say, oh, that's half the year, 6 months. No, it's not. Count the months. Takes 2 seconds. Count them up on your fingers. June, July, August, September, October, November, December. Just like Nick said, 7 months performed in 2027 at $1,500 a month. Multiply that by 7. The total amount earned in 2027, $10,500. Nick, great job. Can you turn your microphone on and do one more thing for me, please? Can you give me the debit and the credit in the adjusting entry? And Nick, your microphone's not on, so if you wanna turn that on.
Oh, there we go.
There you go.
I had my PDF on focus, so my spacebar wasn't unmuting me. For unearned revenue, I debited 10,500.
Go ahead.
And then I could be wrong. I'm hoping I'm right. I did sales revenue credited 10,500.
Nick, I'm going to make, again, you have the absolutely right logic. I'm going to make one small change. I don't like sales revenue. And the reason for that is sales revenue would imply that we have sold a good and would also have cost of goods sold. That's not what we did here, right? We're providing services, not selling a good.
Okay. Would it just be earned revenue then, or would it be something totally different?
Let's call it service revenue,
Oh, okay, that works.
which does represent revenue we've earned. But I think it relates specifically to services. It says we're providing services, so that makes sense. So we'll credit the service revenue to record the revenue earned. 7 months of work done in 2027. So 7 months or 10,500 earned in 2027. Nick, that's an outstanding job. May I ask you one more just quick question, please?
Yeah, what's up?
Can you explain to me why is it in your adjusting entry you debit the unearned revenue?
We debit the unearned revenue because it's a liability. It is not categorized the same way that service revenue is.
And is that liability, Nick, is it increasing or decreasing?
It is decreasing.
It's decreasing. Good job. Excellent work. The liability is going down because you have performed the services. How did Winta define this? Winta said it represents services that we owe. So as we perform the services, we don't owe them anymore. And we have done 7 months of the work. So we reduce the liability for the services we no longer owe and turn that into a revenue because it's now been earned. That's a good one. You definitely want to be comfortable coming into next week with what unearned revenue is, what it's all about, how to do a basic calculation like that, and how to do the adjusting entry. Are there any questions on the second adjustment here? Okay, well done. Let's hear some new voices for number 3. Here's what number 3 says. A physical count. At the end of the year, we went to our supply cabinet and we counted. And based on that physical count, we counted up that we had supplies costing $25,000 still on hand as of December 31st, 2027. I'd like to start, please give me a new volunteer. Supplies. Matthew, supplies is what type of account?
Supplies would be an asset.
Good job. Matthew, agreed 100%. Real quick, are you able to tell me specifically what type of asset is supplies?
Supplies would be a current asset.
Good job. It is an example of a current asset, but here we know it's an asset account. Matthew, next question. Here's what's going on. Let's all take a look at this real quick. 1, 2, 3, 4. 4 from the bottom. We had our supplies an unadjusted balance of $46,000. But then when we actually counted at the end of the year, we only had supplies of $25,000. Matthew, what has happened here? What's happened to some of these supplies?
So throughout the year, that means you used however much
Excellent.
supplies in the process of making goods or whatnot.
Yeah, that's an excellent answer. Some of the supplies have been used up. They are gone. And just an excellent example of that. These markers that I use when I write stuff for our class. This is an example of a supply. And at some point, they still write pretty good. But at some point, they're just not going to write that good anymore. And at that point, I'm going to throw them away and open up a new thing of markers. And when those markers get thrown away, they are being used up. The same thing here with ABC Company in our problem. we can pretty easily figure out the supplies that were used up. We started with supplies of 46,000, the unadjusted balance. At the end of the year, based on our count, we only had 25,000 left. So during 2027, 21,000 of supplies were used up in the course of our operations. Matthew, can you please turn the microphone on? Next question. Good job. Next question. Matthew, when an asset, such as supplies, when an asset gets used up, what does it become, or what does it turn into?
It turns into an expense.
Good job. In fact, I think that is important enough for us to let's write that down. The using up of an asset becomes an expense. Using up of an asset becomes an expense. And that's why we need an adjusting entry. We need to account for the supplies that were used up, and thus we need to turn them into an expense. Matthew, great job. You got one more thing to do. Please turn the microphone on. Are you able to give me the debit and the credit in our adjusting entry?
Yeah, so you would debit a supplies expense for the 21,000.
Okay.
Then you would credit supplies itself for 21,000 since you used them up.
Great job. Matthew, I'm going to have one last question in a moment. Let me get caught up. The using up of an asset becomes an expense. So when we use up supplies, that turns into supplies expense. And we used up 21,000 of the supplies. Turn that into an expense. And he told us to credit the supplies account. 21,000. Matthew, here's my last question to you. Can you explain to me, why is it in this adjusting entry you are going to credit the account supplies?
Since supplies is an asset, when it is decreased, and in this case, since we use the supplies, it ends up crediting it as opposed to debiting it.
Enough said. Great job. Excellent work. The supplies is an asset. And that asset is decreasing because some of these supplies have been used up. We learned last week, asset, decrease, credit. Hence, we will credit the supplies to reduce the asset. That was a great job. Well done, Matthew. Any questions on number 3? All right, good work. Take a look at number 4. I'm going to ask for a new volunteer in a minute. Number 4 tells us that the prepaid insurance, and again, the accounts, the unadjusted numbers are listed alphabetically, maybe about 2/3 of the way down. You see the prepaid insurance. The prepaid insurance relates to a 2-year fire insurance policy that ABC Company purchased on June 1st, 2027. My first question. Prepaid insurance is a new account that we learned just this week. What type of account is it? Chloe, what type of account would we classify prepaid insurance as?
An asset.
Very good. Anytime you guys see the word prepaid, that should just signify to you, all right, we have an asset. Prepaid rent, prepaid advertising, prepaid insurance, whatever. The prepaids are asset accounts. So I know prepaid insurance is an asset. Chloe, good job. Next question for you, please. Chloe, are you able to tell me why is it we will need an adjusting entry at December 31st related to the prepaid insurance?
Because part of the like insurance has been used up.
That sounds like an excellent answer. Some of the assets, some of the prepaid insurance has been used up. And we just saw not but a few moments ago, when an asset gets used up, it becomes an expense, and we need an adjusting entry to do that. Chloe, good job. Next question. We need to figure out how much of the prepaid insurance was used up in 2027. Are you able to give me the numbers out of the problem to come up with that?
We do 30,000 divided by 24.
Let me get caught up, but I like where you're at. She says, well, hey, look, here's the prepaid insurance. What we paid to buy that policy was $30,000, and it is a 2-year policy. Now, there's 12 months in a year. 2 years is 24 months. Take 30,000, divide by the 24 months, and that tells us we are using up $1,250 of the policy per month. Now what, Chloe?
Let's see. Let me see how many months.
How many months did we use up in 2027?
6.
How many?
6.
Chloe, do you mind? Can we just do one thing real quick here? So we are told that the policy was purchased on June 1st, right?
Oh, it would be 7. I'm sorry.
That's okay, but that sounds like a better answer. Let's count them up. Don't, and again, it's real easy, particularly June 1. You look at it, you think, oh, that's half the year, but it's not. June, July, August, September, October, November, December. 7 months used up in 2027 at $1,250 a month. The total amount of the prepaid insurance used up in 2027, $87.50. All right, Chloe, great job. You got just one last thing to do for me, please. Can you give me the debit and the credit in our adjusting entry?
You would debit insurance expense and credit prepaid insurance.
Great job. Excellent work. You can go ahead and mute your microphone. It is essentially the exact same thing that we did in number 3. We are using up an asset. In number 3, we were using up supplies, so it became supplies expense. Number 4, we're using up prepaid insurance, so it becomes insurance expense. So to record this, we will debit our insurance expense to record the expense, just like we did here when we debited supplies expense. And the credit is to the asset to reduce the asset because some of it has been used up. So we will credit to reduce our prepaid insurance. $87.50. All right, that's a good one too. You definitely want to make sure you are comfortable with the prepaid stuff. Any questions on number 4? Take a look at number 5. I'm going to get it started, but I'd like maybe somebody to then finish it for me. Number 5 tells us that the equipment, and again, the equipment you can find maybe about a third of the way down here. The equipment was purchased on January 1st of 2027, and it was assigned a 10-year life and a $7,000 residual value. And I know that what I'm going to have to record here is our depreciation. Depreciation is the using up of long-term assets like buildings and equipment. And the good news is we have a nice, easy equation to follow to calculate depreciation. Take the asset's cost, subtract the residual value, and divide by the asset's life. And we have all those numbers provided to us in the problem. The cost, the equipment right here. On the books at its cost, $97,000. From number 5, they told us the equipment had a $7,000 residual value and a 10-year life, indicating we are going to depreciate $9,000 of the equipment's cost every year. Can I please ask for a new volunteer? And can you tell me the adjusting entry, the debit and the credit in the adjusting entry? Luke, excellent. Your mic's on. Luke, debit and credit, what are they?
So you would debit depreciation expense to 9,000,
Okay.
and then you would credit accumulated depreciation 9,000.
Great job. Luke, I in a minute, I'll be back to you. I have another question, but let me write what you said. Said, all right, to record depreciation, you will debit the expense. We are recording the expense. So debit our depreciation expense, and we'll credit the account called accumulated depreciation. So credit the accumulated 9,000. And when I look at that adjusting entry, the depreciation expense, that one's kind of easy and obvious to me. I know it is an expense account. My goodness, it tells us right there in the name. It is an expense account. But Luke, the accumulated depreciation isn't quite as obvious. Are you able to tell me what type of account is accumulated depreciation?
Man, I can't remember. Is it oh my God. Yeah, I don't know. I'm kind of blanking.
That's okay. No worries. Mute your microphone. Somebody jump in and help out. What type of account is accumulated depreciation?
It's a
Contract.
asset, right?
Very good. Keaton, absolutely correct. It is a contra asset account. So our accumulated depreciation an example of a contra account, specifically a contra asset account. Keaton, may I ask you one more question, please?
Yeah.
What exactly does that mean to be a contra asset account?
So that means when it increases, you would credit it instead of debiting it.
Agreed. And let me ask you one more quick follow-up. So when the accumulated depreciation, like you say, when it increases, we're crediting it. When we record this contra asset, what effect does that have on our assets? Increase or decrease?
Decrease.
Of course it does. That is what a contra account does. It has the effect of decreasing whatever it is contra to. So the contra asset accumulated depreciation has the effect of decreasing our assets. Keaton, great job. May I ask you one more just quick question, please?
Yep.
Keaton, last week, we learned another contra account. Do you remember what it was?
I can't think of it right now.
Okay. I got to mute your microphone. Can somebody jump in and take that? Christopher, excellent. Christopher, what was the other contra account that we have learned?
I believe it was a contra equity account.
Was. Christopher, do you remember what the account was?
Ooh, depreciation
It's not depreciation.
or dividends.
That sounds like
Yeah.
another D, right? But that
Yeah.
sounds like a good answer. And Christopher, one more quick question. So dividends is a contra equity account, meaning it results in a decrease to our equity. Christopher, are you able to tell me specifically which equity account is decreased by dividends?
Is it common stock?
Oh, I'll give you another chance.
I think I'm blanking on that one.
That's okay. I'll help out a little bit. You got to mute your microphone. It's the retained earnings. Retained earnings, remember, beginning retained earnings plus net income minus dividends. Dividends contra equity reduces retained earnings. Accumulated depreciation, contra asset, it reduces our assets. Any questions on number 5?
I missed, what was the other contra asset that we mentioned last week?
Nick, it wasn't a contra asset. It was a contra equity. And that was the dividends. Any other questions? All right, very good. Take a look at number 6. Number 6 tells us about the note payable. And we've learned, right, that a note payable is a bank loan. And it says that the note payable, which you guys will find maybe a little more than halfway down notes payable. The note payable is a bank loan taken out on August 1st of 2027. It is a 9-month, 10% loan. And I know that what I'm going to have to record here in my adjusting entry is the interest. And the good news, we have a nice, easy equation to calculate interest. Principal times rate times time. PRT. Principal times rate times time gives us interest. And what I don't want you guys to do just yet, I'm going to put the numbers up here, but I'm going to make a mistake. And then I want to hear a new volunteer, so new voice, tell me what mistake I've made. Here's what I would do. If you gave me this question and wanted me to calculate the interest, I would know the principal is what we borrowed. I find that in the note payable, 93,000. So again, don't write this down just yet. The interest rate is given here in number 6, 10%. The time is always, every time, without fail, a fraction over 12. The rate is an annual rate. By dividing by 12, we adjust it to a monthly rate. And then back here in number 6, it said it was a 9-month loan. So 9/12. All right, new volunteer. Where is my mistake? All right, Casey, very good. Your mic's on. Casey, where's my mistake?
10% would be represented as 0.1, not 10.
I don't, I disagree, but I've got the percentage sign there, Casey.
Okay.
Well, I think that that's okay. I don't think that's my issue. Grant.
I don't know.
Oh, that's okay. Grant, your microphone's on. Grant, where is my mistake?
It'd be the top of the fraction, that 9. It should be, including August, it'd be 5.
Well, that sounds like a great answer. Grant, mute your microphone, but I will be back to you with another question in a few minutes. Now, look, guys, the interest calculation is easy. It's also easy to mess up. And it's one of those ones that if you mess it up and you look at it later, you kind of want to beat your head against the wall and say, how did I do that? And if you're going to make a mistake, it's going to be right there in the numerator of that fraction. Folks see that it is a 9-month loan and they feel like they've got to get the 9 into that calculation somewhere. And it shouldn't be anywhere. It's not in that calculation. The numerator of the fraction should represent how many months in this year the loan has been outstanding. As Grant said, the loan was taken out on August 1st. So August, September, October, November, December. In 2027, that loan has been outstanding 5 months. So we can calculate our interest. Principal times rate times time. Time is always a fraction over 12. The numerator, how many months in that year, in this case 2027, the loan was outstanding. Giving us interest for 2027, $38.75. In a minute, I will give you the adjusting entry. I will then ask Grant to do a quick calculation for me. But before we do either of those things, any questions from you on the numbers here?
I was just going to ask, in this class, will we ever deal with compounding interest or just simple interest?
Nope, we will deal with compounding interest, though that won't happen until right before exam 2. So right after exam 2. So for now, it's just simple interest like what we see here. But a little later down the road, we will look at compounding of interest. Any other questions? All right, let me give you the adjusting entry. And then, like I said, I have a calculation for Grant I'll ask him to do. I've got to record the expense in the year it was incurred. And in 2027, 5 months of interest totaling $38.75 was incurred. So I will debit my interest expense to record the expense. $38.75. Now, one thing to remember what the modules told you this week, when you watch the modules and you watch the module on interest, it said we make one basic assumption for now. Much later in the semester, we will relax that assumption. But for now, we assume nothing is paid on the loan until the end of the loan. So we're not making, say, a monthly payment of some principal and interest. Nothing is paid until the end. Why that is relevant is as of December 31st, we are not paying any cash, but we now owe the bank 5 months of interest of $38.75. So the credit in my adjusting entry would be to interest payable, $38.75. All right, Grant, would you please turn the microphone back on? Grant, what if I asked you? What if I said, hey, I want you to do a calculation for me? And I'll just go to another piece of paper here for a moment. And what I would like for you to do is I want you to calculate the amount of interest expense related to this loan that we just were looking at. Calculate the amount of interest expense related to this loan that ABC Company would record not in 2027. Grant already know. In 2027, the interest expense is $38.75. I want to know the amount of interest expense recorded next year. In 2028. Grant, are you able to give me the numbers to do that calculation?
Yeah, so you'd still keep the 93,000 times the 10%. And then the fraction would be 4/12 because it's 9 months and we've already done 5.
Great job. Good job, Grant. You can mute your microphone, but excellent work. Look, it is a 9-month loan. The issue that we have is that those 9 months span 2 different years. 5 of the months happened in 2027, and thus were an expense in 2027. But it's a 9-month loan, so there are 4 more months that will happen in 2028, and thus need to be recorded as an expense in 2028. $3,100. Oh, Grant, can I ask you one more quick question, please?
Yeah.
Your exam is next Monday night. How likely is it that I am going to ask you as one of the questions an interest question?
100%.
Oh, that's a good answer. Not probably or likely. It is guaranteed. Good job, Grant. Mute your microphone. Guaranteed next week, one of your questions will be an interest calculation. And as I said, it's easy to do. But you got to pay attention. Accounting is detailed. And you got to pay attention to the details. No detail more important than a date. So if I gave you that problem and said, what is the interest expense in 2027? You tell me $38.75. If I say, what is the interest expense in 2028? You tell me $3,100. Based on how many months of that loan happen in each of those years. Watch that on quiz 2 as well. Quiz 2, don't forget, is due Thursday. And one of the questions is an interest calculation. And so make sure you're calculating the interest for the proper year. All right, any questions really on any of the work that we did in those 6 adjusting entries?
I have a quick question.
Go ahead, Carter.
So for the exam, when you're going to ask us about the interest calculation, do you want us to calculate the interest in the following year as well?
I do not. What I want is whatever year I ask you for. So if it says calculate the interest in 2027, all I want is 3875.
Gotcha.
If it says 2028, all I want is 3100.
Okay, cool. Thank you.
Any other questions? All right, we've got one more thing to do. One more requirement in our problem. And it is to calculate ABC Company's total liabilities at December 31st, 2027. I have just one quick question. Let's see here. And I'll take anybody. And let me rephrase. I'll take anybody I haven't heard from. So how about a new voice, please? To identify liabilities from a list of accounts like this, what is the buzzword? What word indicates liability? Alec, excellent. Your mic's on. Alec, what word means liability?
That expense.
Well, Alec, I'm not sure I want to agree with that. If I see the word expense, that's telling me it is an expense account. I want to know what word means liability account. Nick, your microphone's on.
It would be payable.
Things that say payable would be our liabilities. Nick, how about I do it and you tell me if you agree or not with my calculations? Now, Nick has said to identify the liabilities, things that say payable. And look at that very first one. Accounts payable, $58,000. Got to include it. That is a liability. Let's keep looking. And we look and we look and look and look and look and look and look for things that say payable. Oh my goodness, right there. Notes payable, 93,000. So we got to include that as well. And we look and look and look and look and look. Oh my goodness, there aren't any more. Nothing else that says payable. Nick, turn the mic on. Agree or disagree? Total liabilities.
I disagree. Because
Yeah.
we did these adjustments, and there was one called salaries payable. We got to include that.
Hold on, Nick. Hold on. So are you trying to tell me that we have to include the effects of the adjusting entries?
Oh my goodness.
Shocking, isn't it? We did not make these adjusting entries for fun. In fact, I'm willing to bet that the only person here that had any fun writing out the adjusting entries was me. We write these adjusting entries out because they become part of the accounting records. And as Nick said, in those adjusting entries, we created a couple of additional liabilities. From the very first one, we now owe our employees $12,000. The salaries payable is a liability. And from the very last adjusting entry, we also have reflected that we owe the bank $38.75 of interest. interest payable is a liability. Nick, please turn the microphone back on. Is there anything else we need to include?
Well, I was looking here and I'm not sure, so I could be wrong.
Okay.
Never mind. Well, I was gonna say accumulated depreciation, but that's a contra asset, so I don't.
It is. That's contra asset. I don't want to include that, right? We defined that one as a contra asset. Can I ask?
Yes, unearned revenue is a liability.
Oh boy. We did identify the unearned revenue, even though it doesn't say payable. The unearned revenue is a liability account, which means we need to include the unearned revenue in this calculation. Once we do that, we'll be able to come up with our total liabilities at December 31, 2027. Good job, Nick. I have a question. I'd like maybe somebody else to finish it up. Last one for the night. Can you tell me how to come up with, can you tell me how to come up with the balance in the unearned revenue account at December 31st, 2027? How would you come up with the amount to include there in our calculation? Abby, excellent. Your microphone's on. Abby, how would you do this?
Would you subtract the 10,500 from the 27,000?
Boy, that sounds like a good answer to me. Good job, Abby. Well done. We know that the unearned revenue started at $27,000. When we got the money from the customer, we owed them 18 months of services, and that was $27,000. But then at the end of the year, we made that adjusting entry to account for the 7 months of services we have since provided. And as part of that adjusting entry, we debited it to reduce the liability because we don't owe those services anymore. Those 7 months have been given. So as of the end of the year, let's see if I can squeeze this in here. As of the end of the year, the unearned revenue, the services that we still owe, well, that looks like $16,500. Taking what we started with and subtracting what we've actually done during the year. Giving us, when you press your buttons, giving us total liabilities at December 31st, $183,375. That's pretty good calculation. Any questions on what was done here?
I had a question about contra assets. If the question instead asked us what were total assets instead of total liabilities, would we include the accumulated depreciation or no?
Yes, we would. But Nick, if you don't mind, quick question. We would include the accumulated depreciation
but it would be a subtraction.
As a decrease, right?
Yes.
It would be a decrease to the assets. So we would subtract it, not add it. Any other questions? Okay, great job. Before we finish it up for the evening, can we talk for a couple minutes about your upcoming exam next Monday? First thing to remember, the exam is next Monday night during our regular class time, 5:30 to 7. And because we have an exam on Monday, there is no class on Wednesday. So you don't need to be anywhere on Zoom next Wednesday with Jake. No class, no Wednesday classes held when we have an exam. The exam is in person. So you need to go to your classroom assigned at the regional campus. And there's where the classrooms are. So if you are a Lima student, you would go to Galvin room 450. Marion, go to Morrill Hall, room 206. Mansfield, go to Conard Learning Center, room 120H. And at Newark, you would go to Reese Center, room 224. So make sure you mark down and know what room you're supposed to be in next Monday, starting at 5:30 for the exam. You will need a calculator. Obviously, it's a counting class, bunch of numbers. No graphing calculators allowed. Don't bring them. The TI-84s, you can't use them. Financial calculator, perfectly fine. Just as long as it adds, subtracts, multiplies, divides. But the programmable ones like the TI-84s can't use. Obviously, this doesn't need to be said, but I'll say it anyway. You cannot use electronic devices like a cell phone or a laptop as your calculator. Make sure you have a usable calculator. The exam itself consists of 32 questions. 8 of those questions are a matching a set. So what I will do, if I just come here real quick, I am going to give you 8 definitions. And then I'll give you a bunch of choices. And you'll have to match the definition to the correct choice. So you'll have 8 of those. There are 14 conceptual or definitional type multiple choice questions. And then there are 10 calculation multiple choice questions. You know, we've already said tonight, one of those 10 would be an interest calculation. Here's a loan, here's the information, what's the amount of interest expense in whatever year is asked for. Do you guys have, oh, one other thing, and I think I might have forgotten to do this. So as soon as our class ends and I close everything down, I am going to go into Carmen and I will post a sample exam. So there will be a sample exam posted in Carmen with solutions to help you prepare for the regular test next Monday night. Are there any questions on anything related to the exam?
How long do we have to take the exam?
1 hour, 30 minutes. So you may work 5:30 to 7. Any other questions?
Yeah, so is the exam on paper or on the computer?
It is paper pencil. So it's not on the computer. You do not need a computer of any kind. Any other questions?
I have a question.
Go ahead, Forrest.
So I primarily take my classes at Columbus. If I had to guess, I believe I should be going to the Marion classroom, but is there somewhere I could double check to make sure I'm at the right place at the right time?
Yeah, what you'd have to do, Forrest, is you have to look at the class that you're registered for.
Okay.
It should tell you which regional campus that's at. And then whatever one you are registered for, you would then go to whatever room that it's going to happen in.
Okay, thank you.
Yeah, I'd have to look up your registration, but you can do that just as easily as I can, if not easier.
Yeah, if you pull up your weekly class schedule view on Carmen, it'll tell you what room it is.
Okay, thank you.
Anybody else?
So I only have like one calculator. I think it's like an older graphic calculator. I can't use that, you said?
You can't use it, Alex. If it's a TI-84, can't use it.
I think it's like an 82. Like it's old.
My guess is that's still the program. You can send me email me a picture of it. I can.
Cause it's just like I don't know. I got it from a garage sale. I don't know.
My guess is that it's a no. So
Okay.
you can pick up a very basic calculator, Target, Walmart, Office Max, pretty
Yeah.
cheap. So
Okay.
you might, like I said, you can email me a picture of it. I'll look at it, but my guess is no. So you
All
probably
right. Yeah. Yeah. I'll email you one and just
Yeah.
check.
Yep.
All right. Thanks.
You're welcome. All right, guys. Any final questions?
I have a question about the quiz.
Specific question about how to do something or a general question?
Just like a general question.
Oh, go ahead.
Is it just about like our past 2 weeks, what we've learned in the past 2 weeks?
Yes.
Okay.
The quiz covers transaction analysis and the adjusting and closing process. And just for future reference, if you look in the syllabus on the pages about the quizzes, there's a schedule there that'll tell you what topics are covered on each quiz. All right, guys, that is what I had for you. If you are done, have a fantastic evening.